Welcome back, ladies and gentlemen. Please take your seats. Coming up now is a panel that goes right to the heart of the money question, where capital is moving and who wins or loses in the process. Our next session is titled Capital on the Move, Winners and Losers in a Fragmenting World. That this panel discussion follows the money and quite literally.
You see, last month alone, emerging market portfolios attracted over $55 billion in net inflows, making it the second largest monthly inflow in 4 years as investors chased both opportunity amid volatility.
Now, to unpack all of that, we are joining by the managing partner and global CIO at Heinz, overseeing a $94 billion global portfolio, David Steinbach.
The global head of equity strategy at Jefferies, Christopher Wood.
The CEO and CIO at Asia Pacific at Allianz Investment Management, Ritu Arora.
And moderating this session, Arijit Berman, Associate Editor at The Economic Times.
Panelists and Arijit, can we invite you onto stage?
And a big round of applause for our panelists, please. Please don't mind the distraction. The security team will move out shortly. Do give the panel your full attention. Thank you.
Yep, all yours, Arijit.
Thank you, guys. Abha, thanks for that intro, because that's exactly what I was planning to say. Now that there's a race against time, thanks for setting the agenda. Gentlemen, and Ritu, thank you very much for taking time out. Ritu, let's start straight away, because we don't have a 40-minute session anymore. Tariffs, it seems, has only compounded the woes of Indian equities. Earlier, the concerns were largely slowing earnings growth, rich valuations vis-a-vis India. If you look at the net outflows, it's almost 13 billion year to date from the foreign portfolios. Do we need to worry, or, as they say, mutual funds henna, so we are safe?
Thank you, Arijit, for a very interesting question to start the panel with. Tariffs have been unexpected, have been unpredictable, and hence they have caused quite a flutter. And it's quite clear that they will have a large impact on global growth. So a rough estimate, BlackRock has put out a number that 20% average tariff means global growth goes down by 2.5%. And if that is the kind of impact on growth, then markets have to reflect that. For now, they've been resilient. The domestic investors have kind of made sure that they bring in enough or more when we see these 13 billion outflows. But one has to be careful and budget in as one makes allocation decisions, not just diversification, which is probably as old as investing itself, but also be sensitive to the risk linked with countries, currencies, have flexibility in the portfolio to be able to maneuver it for shocks. Probably also find a portfolio that now also has exposures to some commodities, some safe haven assets like gold. Pick up sectors more carefully. Some sectors would benefit or be resilient or safe from this uncertainty, sectors like pharma, health, IT, etc., defense. So I think it has to be a mix of all this to navigate the uncertainty.
Right. And Chris, would you advise your clients that, geopolitics or tariffs, these issues are no longer passing shocks. These are more structural features of global economy and therefore more long-term or medium-term. And accordingly, investors should redesign or rethink their portfolio construction?
It's a microphone. Yeah. My view is that the tariffs are a zero-sum game. So what's been amazing is how resilient the markets have been in the face of Donald Trump's tariff agenda. But I think the longer time goes on, the more, if this agenda is persisted with, the more it will become clear that it's a negative. But I think at the end of the day, the tariffs will end up being most negative for the US because it's a tax on American consumers.
Right. David, you'd called this moment a liminal space which is a transition from low rates to something new. But maybe a more fundamental question to ask is, are we returning to financial normalcy, or are we entering a permanently different era that demands a rethink on things like real estate strategies and capital deployment?
Yeah, I think it's, for me, certainly the latter. I mean, I think we are in a new era, and I think I've used this analogy before of a liminal space. You know, architects, when they design a building, you know, it's a liminal space is like a hallway or a stairway. It's kind of a space in between two rooms. And I think that's where we are right now. We haven't yet entered into this new room fully. You know, these deals, we don't know what these deals are yet. We don't know how, what the exact contours are going to be of the new economy. But I think on the other side of it, you know, businesses are resilient and creative and innovative. And everywhere, India included, will figure out new ways of working. And that might be rethinking exactly where things are made. There might be some onshoring in different places that even some of the great Indian manufacturers take advantage of in new ways. So there'll be a new way through, and I think it's our job in business to figure that out. And I think that's also where the opportunity is to figure out what that new world looks like.
Chris, are we looking at a world where rival financial systems would exist, like one which is the Western, you know, which has SWIFT in the middle as a technology, as a tech backbone, and one Asia-led?
Well, I think there's a sort of BRIC initiative to reduce dependence on the US dollar. Yeah. Though I think India is less enthusiastic about that than the other members of BRICS. But the Chinese and the Russians are definitely been pursuing an agenda where there's incremental growing trade being done outside the dollar. I think 30% of China's trade in goods is now done outside the US dollar. So I think this is an ongoing pattern. And the hope is that, but I think in response, the US has now decided to champion stable coins as a way of combating this drift away from the US dollar. So it looks like the Trump administration is going to try and co-opt. It's not, in fact, it is co-opting crypto technology.
So how much of what we are seeing today or reading today is actually about politics? How much of it is actually ego?
50-50.
50-50?
At least, yeah.
Isn't it 70-30?
It may be actually, no, that's probably 70-30, you're right. So what the US administration is clearly hoping is that the stable coins, the promotion of stable coins, will create demand for treasury bills.
Right.
Treasury Secretary Scott Bessent has openly championed that cause.
Now, David, coming back to cost of capital, because Ritu talked about balancing or having a more diversified portfolio. Are we looking at a structural hike in global cost of capital?
I do think that we've been living in a 40-year chapter that again has ended, and that 40-year chapter was, I think, defined by globalization itself, and there was a lot of deflationary activity that was a result of that, and that was the world coming together, if you will. And I think in this chapter that we're in now, it is a lot more about the world coming back apart. And I think in that, there's going to be more friction costs, certainly more friction cost in moving goods, tariffs. But there also is going to need to be a lot of expenditure that's going to need to happen in different geographies as infrastructure supply chains are relooked at and built out in different places. It's going to create demand in new places, if you will. And I think that's going to also be a level of spending that is going to need to happen. So I think both those forces are going to cause there to be higher rates in the system. And I think last is the level of debt in much of the West. And I think debt is a supply-demand driven issue in terms of pricing, which is what interest rates represent. And when there's too much supply or supply is growing faster than demand, the pricing does slip. And so I think that also will help to drive rates a bit higher in the longer run.
Right. Ritu, since COVID, we are seeing this catchphrase, supply chain dislocation, or has India managed to capitalize on this the way people had expected compared to other smaller, nimbler, perhaps the Asian tigers?
The dislocation, I believe, has just begun, and it will play out over the next few years, and so the story is developing. India has to its advantage manufacturing, which had picked up with the entire thrust of Make in India. The policy relaxation, liberalization is now firmly in place. Infrastructure, a tad slower, but still developing. So we have the big parts of the jigsaw falling in place, but the urgency needs to be there. Otherwise, we would have strong competition, and it is not going to be just India's gain, what is China's loss. We will have others to share it with, be it Vietnam, Malaysia, Indonesia, but it is still a big dislocation, and India could have significant benefits. And hence, I think we should have all commitment to make sure that we get a lion's share of that dislocation. And we are well positioned. We just need to keep going with full earnestness.
Right. Chris, you track the Indian markets, the Indian corporates. You know, Ritu talked about infrastructure or doubling down on infrastructure. The private sector capacity expansion have fallen to a 3-year low. Bank exposure to our core sectors, which have been predominantly grew on bank finance, whether it's roads, power, telecommunication, that's down to 11% of their loan book. The new RBI governor had slashed the benchmark interest rate by 5.5% within 6 months of coming in. Yet, we don't see that quote-unquote animal spirits kicking in. What's holding India Inc. back?
No, I think that's probably the biggest conundrum in the Indian economy right now. I was definitely expecting more of a pickup in private sector capex in the last 3 years. That has eventuated. The government, talking to government officials this week in Delhi, yesterday in Delhi, it's clear they're wondering why this isn't happening too. So that, to me, is the biggest surprise. So the reality is a real thrust of capex in India in the last 10 years has come from the government.
Right.
And the government has done everything it can, actually, to create a better infrastructure framework. So they've followed a supply-side agenda. So actually, everybody's scratching their heads why we're not seeing more of a pickup in the private sector.
David, in October, S&P had predicted $800 billion tsunami of investments by Indian conglomerates over 10 years in newer areas like green hydrogen, clean energy, semiconductors, data centers. We are not seeing that happening, as Chris also mentioned. So how does one create new assets when the bottleneck is not in supply of credit, but in demand?
Yeah, I think that's a really interesting question. Where is that going to come from? And I think in this conference, there's been a couple of different speakers, I think, unpacked some very interesting elements of that. It is a problem that needs to be solved. I think the world generally agrees on that. And it is a problem that also a lot of people feel they have a solution for. I do think the market needs to get more creative and more compelling in terms of the investment case for it. But I also think that there's a big difference between the private markets and public markets. And I think that the private markets are going to have a very unique answer for this problem. Because just there's a pricing disparity between public and private markets, if you will. And I think actually the private markets are more attractive in how they price things. So I think that is going to be part of the solution, is capital sources that come from places that they didn't come from the last 10 years.
Ritu, we're seeing a lot of that happen in the US from the insurance sector. And the insurance sector is becoming a far bigger and active participant in whether it's in private credit or in actually help build out core infrastructure. How do you see that pan out in emerging markets like India?
So for Allianz, India is a key strategic market, and we are highly committed to India and want to have a long strategic presence. And the FDI bill, 100%, is something we look at with anticipation. Like you rightly said, insurance as a product takes a layer of risk away, and hence not only supports capital formation, preservation, but also investments, because it's after all a financial assets, and it is a significant catalyst in the market. India has low penetration, and I think liberalization will go a long way in bringing niche players, special use insurance, etc. So I'm looking, and Allianz is looking with great anticipation with insurance playing a greater role in financial markets in India.
Chris, you know, India being the last big growth story, always, you know, for many, the Achilles heel has been shallow bond markets and uneven governance. This has been a perennial problem. What will it take for India to build the kind of institutional market depth that we can actually absorb and anchor truly the global capital at scale?
No, I think is the story from a domestic standpoint. I think you have the most dynamic capital market in India, actually, after the US. But one issue, both on the fixed income and the equity, is you have these regulations of what you call FII, which from a portfolio investment standpoint means that India is a more complicated emerging market to invest in than just about any other emerging market I can think of, because you have to go through these regulatory approvals to get the permission to invest in India. So a complete bonfire of those controls would open up India much more. So the reality is most equity investors in India or debt investors are emerging market specialists. Global funds are not really buying India.
Okay. David, in commercial real estate, for example, two of the biggest landlords in India are foreign institutional investors. One is Blackstone, the other is Brookfield. To what extent do you think reforms like the REIT are giving them the courage to double down?
I think it's incredibly important. I think it's one of the biggest things that has happened the last few years. I think more reform in the real estate industry is good for the industry. It'll help to institutionalize the asset class and attract more foreign capital. I mean, the amount of things that need to be built here is staggering in terms of what needs to happen, and making India as attractive as it can be. Part of it is that regulatory environment, and I think that having those public REITs, those listings occur, I think gave the market a lot of confidence, because there's transparency that investors are used to, and that does cascade down into other elements of the industry too. So those listings to me were a pretty important milestone in just the evolution of the markets here.
Right. Ritu, global debt, and you touched upon it, had surged to record highs, whether it's the US, whether it's emerging markets. At what point do you think debt and deficit starts to crowd out private investments and reshape investor return expectations?
I think that's already happening. Public debt is at record high at about 100 trillion, expected to go to 117% of global GDP by 27, which is not so far. So public debt is already crowding out private investment. What it has implication directly is on the borrowing costs and access to capital. And I think we're already witnessing that. It will help to have some kind of interest rate easing, which one anticipates that in September we would see some respite and probably a 25 basis point interest rate cut in the US as well. But I don't think that is an answer in itself. This whole public-private needs a rebalance, where public needs to create that space for private to thrive as debt. In India particularly, the debt markets are not deep enough, very shallow. And we'll have to make structural reforms as well as induce investors, like they've flocked to the equity markets, to come to debt markets as well, to make it a vibrant market.
Chris, we are running out of time, so I just wanted to ask you or understand, when we talk about public debt, which are the asset classes which are most vulnerable if, you know, sustainability of the debt is becoming a defining risk?
Well, yeah, I'd make a distinction here between the G7 world and the emerging markets.
Right.
The real excesses in government debt are in the G7 world. So back in March 2020, when the Fed printed all that money for COVID, I said, sell all G7 government bonds. I think G7 government bonds are in long-term bear markets, and I favor owning local currency emerging market government bonds. because the reality is that the monetary and fiscal policies in the most emerging markets have been much more conservative and bond investor friendly, including here in India, than in the G7 world. And since then, so far, emerging markets bonds are massively outperforming G7 government bonds.
Interesting. David, how should allocators hedge this possibility of the reshape that Chris is also talking about?
Yeah, I think some of the way this is going to play out in some economies is, again, a bit higher rates and a bit higher inflation. And I know in our research team, I've had them go back and look at other cycles where that's occurred. And in the US, for example, it really is the late 60s, 70s is the most interesting kind of corollary you could see for what could happen. In that world, allocations towards real assets actually perform well. Because what happens in that system is a lot of new supply stops getting built because it can't be financed. And that creates a dynamic where rent growth really starts to drive into real estate, for example, which is the world that I live in. And having cash flow is incredibly important and what investors are looking for in cycle moments like you're mentioning.
Right.
Arijit, I think we're just about out of time now.
Okay.
Sorry,
we've run out of time, but thank you, Ritu, Chris, and David, for doing this. Thank you so much.
Thank you. Thank you, panelists. Thank you, Arijit.
Thank you.
Our next session turns to a challenge that every business leader today is grappling with: how to rethink strategy in a world that feels permanently unstable.
Without further ado, let me call the panelists onto stage. The founder and executive chairman of S4 Capital, and a name synonymous with the evolution of global advertising, Sir Martin Sorrell. Sir Martin, can we have you on stage?
From the hospitality industry, the CEO of the Radisson Hotel Group and board director of Louvre Hotels Group, with deep insight into brand resilience and global experience, Federico J. Gonzalez.
Representing one of the world's largest law firms and bringing a legal lens to strategic thinking, Global Chair-elect of Baker McKenzie, Sunny Man.
From La Caisse, one of the world's leading long-term institutional investors, Senior Managing Director and Head of Global Affairs, Dame Sharon White. And finally, the Global Chairman of PwC, advising governments and CEOs on transformation and trust in uncertain times, Mohammed Kande. Moderating this discussion will be Executive Editor of the Economic Times, Shrutajit KK. Can I please have a very big round of applause for our very, very honorable guests?
Ladies and gentlemen, good evening. What a heavy-duty panel we have this evening to discuss this theme. And before we await the arrival of the Honorable Prime Minister, and then we'll get to listen to his thoughts. But here we have a panel of eminent thought leaders and executives who are consulted by the top business leaders of the world. In strategy, in marketing, in every other way. These are minds that the leaders who run the biggest businesses in the world like to pick their thoughts on. Thank you all so much for joining us here today. Such a pleasure to have you. Our theme today, Rethinking Strategy in an Unstable World. I was thinking about this a little while ago. Strategy used to be something that you thought deeply about, and then you set it, and then you followed that for a few years. The world today is such that it's almost like strategy is becoming something that you have to recalibrate far more frequently than used to be the case. As attention spans are coming down, it's almost like, as people are crafting tweets perhaps, you have to have strategies. The world is becoming a very different and sort of a fragmented place, and therefore large global companies can no longer have a global strategy. They want to have, or they need to have, separate strategies for regions, countries, micro markets. So all of this is what I hope to discuss with you and hear from all of you today. Firstly, let me, perhaps I can start with Mohammed. Mohammed, what's the biggest anxiety you hear from the CEOs you talk to today?
So the number one anxiety that we're seeing from CEOs today is not having the answer. And the uncertainty that we are all dealing with today, and that uncertainty turning into unreliability. Because when things are uncertain, we just don't know when they're going to happen. When things are unreliable, we don't know if they will happen or not. What are two separate problems? And that created an anxiety because the last, I would say, 15 years were quite predictable. We knew what the playbooks were, what to do to create value. Now everything is changing. Think about where we are today compared to even 6 months ago. So that anxiety is created by not being able to have an answer to drive the strategies of different organizations.
Sharon, can I come to you with the same question? You talk to a lot of leaders, business leaders around the world. Can you tell us what are the persistent anxieties you're hearing in recent weeks and months?
I mean, anxiety is quite an interesting word. And I mean, I agree with Mohammed that it is a sense that you don't know what the playbook is, that the playbook that worked for you for the last 5 years isn't necessarily going to work for the next 5. But I'd make 2 other points. I think, firstly, it's much more that, you know, geopolitics that might be agenda number 10 on your board pack is suddenly the sort of overarching framework. You know, you, in a sense, you know, the first thing you're turning to in the morning is the, you know, your Wall Street Journal app or your Economic Times app, because a change or a tweet overnight could have had, you know, could wipe potentially 10% off one of your key markets. But I think in this debate, alongside the anxiety, it's also how we think about the opportunities. And, you know, I look at Europe at the moment, possibly the best thing that's happened to Europe, and the prospect of structural reform is actually the anxiety of less reliable partners than we've had in the past.
So you're about to chair one of the world's largest law firms. Firstly, congratulations on the election. And secondly, you know, does this resonate with you, or having been advising a lot of global businesses over the years, would you say that, look, this has been the order of doing business around the world? It's, you know, this is not a particularly bumpy time. It's just that it feels that way, but things have always been topsy-turvy. Is that something you would say?
Yeah. Perhaps just to, before I dive into that question, I want to take a moment to congratulate the Economic Times, because I think you've done a brilliant job of pulling together amazing thought leaders to help contribute to solving some of the world's biggest problems. So congratulations on doing that. To respond to your question, it's fascinating because people talk about this being the new normal. And I get it. Geopolitical disruption has led to severe and intense disruption for supply chains, trade, investment flows. But many of my colleagues who've perhaps been working for a little bit longer have reminded me that actually, in a certain sense, this is like the old normal. Because I think for those of us in business today, we've got used to 3 decades of prosperity, stability, growth, trade barriers coming down, investment and trade flows going up. But if you rewind back to the 80s, to the 70s, to the 60s, the world was fragmented. You had the Cold War with a split down the middle between 2 large blocks, but even underlying that, you actually had a lot of regional blocks emerging. So the world was very complex, and I think what companies have to do is almost re-hardwire their way of thinking back to an old normal. And so, as you know, Dame Sharon put it really well, absolutely, this fragmentation creates intense risk. Who was talking about tariffs a year ago? But now it's a C-suite issue. It's the biggest thing we're advising companies on. But when you reshuffle the deck materially, which is what is happening in the world order, there's a reshuffling of the deck, opportunities arise as well. And through that cloud of risk, the companies that will succeed are the ones who identify the opportunities.
Lovely. Federico, I will put the question to you a little differently, since you know, you run a very large services corporation with presence all over the world. since you are traveling to all these different regions, what is the sense in terms of the business sentiment among your partners and others that you're picking up? Is it more intense in some regions vis-a-vis the others?
Well, actually it is, but I would say it's changing. It's like it all depends on when you start the discussion and the moment in which you are in a given place. It's like if you look 12 months ago, okay, there were certain parts of the world that were set for a given growth rate and a given, increase in hotels, in occupancies, or in RevPARs, and then suddenly something happens and then affects completely the sentiment of that country. I think obviously there are trends that you all know. I mean, obviously China is slow, has been slow for some time. India has been booming, okay, even if there has been 1 or 2 months of periods with some higher level of uncertainty. Africa is kind of stable, but actually the key locations in Africa keep doing pretty well. The US is stable, Latin America is stable, and then across EMEA, there are different countries. Germany is kind of stable, also has been stable and slightly down. But actually you see Southern Europe doing quite well. Some of the key towns, and many times it's not countries, it's given concrete destinations that are doing better or worse, okay? But I think the sentiment, and going back to the point that has been mentioned, I think anxiety and uncertainty, in my experience, has always been there. It's maybe of different nature. And I want to take advantage of the question you made about anxiety. For me, the thing that drives my anxiety the highest is actually how to find the relevant information. If I compare myself today with when I started to work in Procter & Gamble 30 years ago, there was very clear sources of information you would trust. And technology-wise, I have to say the change was also big. There was only one computer in the office when I started to work. And then a lot of change has happened. But I think for me, the most anxious point is, which are the sources of truth today? Where do I get the relevant? Because there is so much information. There is so many people talking about so many things that you really...
I mean, if you lived in India, I could tell you it's the Economic Times, but...
That's right. But that, I think, it would say. That's what I would say. Thank you.
Wonderful. I just want to add one more. Since you run a business that is so dependent on reliable supply chains, could you just give us a flavor of what that is like right now? How much more critical supply chain management has become?
There has been a significant change and shock during some periods on the construction side. First, it was COVID that altered significantly the construction cost, and I have to say it drove many new projects to collapse, okay, completely. I think from a logistics point of view, sourcing of the key construction elements keeps being one key driver of decisions. And I think now in the future, actually, more than the new constructions, I think the highest worry, if you wish, is actually we need to convert many of the existing buildings and turn them into sustainable buildings. And that requires new technologies, new investments, and I think that is what is being designed for the future, and these changes in supply chains alter actually the cost and the time it will take to convert all those buildings into sustainable units.
Wonderful. Really well said, Federico. Thank you. Let me come to you now, Sir Martin. You're in the business of helping the world's biggest companies tell the world what they're about, what their values are, what they stand for. How is that whole business getting disrupted?
Well, just to, being tail end Charlie in this discussion, so pick up some of the themes that have already been said. So you have 3 major geopolitical risks which are top of everybody's agenda. We've been here in India the last 48, 72 hours. It's interesting that Indian CEOs, when you ask them what is the thing that keeps them up at night, wake up in the morning, they worry about its geopolitical risk. More probably in relation to issues around Pakistan, maybe, in the context of India, but the 3 biggest ones are US-China relationships, or lack of them, Russia, and Iran. Now, you layer on top of that tariffs, you have a considerable degree of uncertainty. Most corporations, there is a separation of ownership and control. There's not a unification of ownership and control. Only in more entrepreneurial companies and countries is that the case. In that situation, what you get when you get increased uncertainty is delay. And I think what we're seeing at the moment, layered on the top of those three major risks, is this concern around tariffs. Once tariffs settle down, and we know exactly where they are, and it will be a new normal, because tariffs were running at around 1 or 2%, and it looks like they're going to settle around 15% or that level. There will be greater numbers and lesser numbers in some cases, but that's going to be the new normal. And I do think we've gone into a new age. You may go job back to 50s and 60s. I'm 80 years old. I can't job back as far as that, but we have gone through a golden era, the last 40 or 50 years, relatively peaceful, high growth, global growth above 3%, inflation under control, and interest rates, remember, in some jurisdictions, even negative interest rates. The new normal is slower growth, higher inflation. Inflation is much more stubborn, as previous speakers have said on other sessions. Tariffs will drive inflation, at least have a one-time effect. And as a result, you're going to have lower growth, growth below 3% globally. You're going to have higher inflation, more stubborn. UK inflation is running at 3.8%. US is stuck at 3%, despite what the chairman said in Jackson Hole 24 hours ago, and lowering interest rates, but they'll still be higher than we're used to. In that environment, two things are really important for CEOs. The first is it's no longer the Ted Levitt. If you remember Ted Levitt, the professor at Harvard Business School, talked about globalization in the 1980s. Consumers will consume everything in the same way everywhere. That is no longer the case. Maybe not the end of globalization, but certainly the word that's been used, fragmentation. So pick your geography. Number one, pick your geographies carefully. And the geographies that attract us and our clients, or our clients and us, are the US, Latin America, as you mentioned, the Middle East, and Asia. Africa, without wanting to offend anybody, too much volatility. It's more micro than macro. And Europe, I'm very negative on Europe. I'm very bearish on Europe. The problems that France faces, Italy faces, the UK, and maybe to a lesser extent Spain, are considerable. Germany is the one more brighter light. The fiscal spending is about 65% of GDP. There's more headroom, fiscal headroom there, and certainly defense spending, as the Americans sort of withdraw from supporting NATO to the extent they've done, defense spending comes to the fore. But that's the general pattern. In Asia, there is the China risk. If you're big in China, and I define big as being over 15 to 20% of your sales coming out of China, because China is 18 trillion out of 106 trillion, so that's the rough weighting. If you're Tesla, if you're LVMH, if you're Apple, do you really want to take the Taiwan risk? I don't think the Taiwan risk is invasion, but it's certainly constriction on Taiwan. So India comes to the fore in that context, along with Indonesia, Vietnam, Singapore, Malaysia, the Philippines, and Thailand, what I call New Asia, rather than as much Japan, Australia, and New Zealand. So that's number one. Number two, and we haven't touched on this, technology. In that slower growth world, efficiency is really going to become important. So the moment that we get some sort of certainty about the levels of tariffs, I think AI, quantum computing, and blockchain, these big technological advances, are going to kick in very heavily, because clients will be under pressure to maintain margins or even increase them in a world of slower growth, higher inflation, and higher interest rates than we have been used to.
You've painted on a wide canvas of intellectual themes, and that was amazing. I want to come to you, Mohammed, on one of the points that Sir Martin made. He said, low growth around the world is going to be the... Lower growth around the world is going to be the new normal. Do you agree?
I do agree that we will see lower growth. But in the industries that we know, as of today. The point that Sir Martin was making on technology, when you think about quantum computing, when you think about blockchain, even when you think about AI, you think about the additional value that will be created by all these companies. And I will tell you why I'm so bullish with technology. If you remember what happened in 2001 with the mobile internet, the launch of 3G networks and the mobile internet, it was a technology not only for people to make phone calls, but to use their cell phones to go on the internet. Think since then, all the things that happened that didn't exist before 2001. Today, you wouldn't have social media, you wouldn't have the cloud, you wouldn't have e-commerce. All this was created because that technology enabled people to get on the internet using their cell phone. Now we talk about AI, quantum computing that is coming, and blockchain. I truly believe that in the midst of all of the tariff and trade issues that we are facing today, we are going to witness a new age of innovation, because we think there is low growth for what we know today. But what about the new stuff that is coming in? And new things will come. Why? There is way too much capital, too much money being invested in all of these technologies to not create additional business models, additional companies, additional jobs, et cetera, So low growth in what we know today, but maybe higher growth in the new things that will be created. We don't know what the answer is. That's the anxiety. But when you see so much capital being deployed in specific technology, good things are bound to happen. So I believe that this new intelligence age, as I mentioned before, it's going to also be an age of innovation on new stuff, even if the current stuff is going to slow down a little bit.
I want to ask you one more question, and this is, I'm just throwing it up for the panel more broadly, and in your specific comments, please also feel free to respond to this. You know, the broad sort of consensus of, you know, capitalism, free markets, and the liberal world order, which has around the world brought in unprecedented prosperity over the last 5 or 6 decades, increasingly for geopolitical and other policy reasons, like the United States' stand on reciprocal tariffs. It seems like there is, a wave against globalization and more towards, the world sort of drifting apart into trade blocs and other kind of. So is that another factor that you see that could contribute to the growth rate lowering?
So it looks like that is true that there is a realignment, for lack of a better term, depending on different regions. But I know when we say globalization, the new coalition of realignment might be cross-continental. We just have to see what the new trading routes are going to be created based on what is needed. But remember that there is 2 things that are happening today. Trade and tariffs increases the borders between companies, or the border for trading. Technology does exactly the opposite. That's the thing. Technology takes the barriers to entry of any industry very down. So we believe, at least when you look at, regionalization, when you think about investment, when you think about trade, money is like water. Eventually finds a way to move around. That's the reality now. Is that going to take a year? Is that going to take 2 years? Many of the large corporations in the world will figure out a way to make money, because that is why they're in business today. So growth will slow down, that is true. But eventually, we're going to go back to a golden age of growth. Why? Because there's so much capital that is being invested. It will create something new.
I want to go to Sharon once more. Sharon, you are a major global investor. Can you quickly take us through what are the biggest breakthrough opportunities you see around the world?
I will do, and I want to say very briefly that I think it's really important that we don't get caught into a doom loop. Yeah. And while sort of recognizing that there is a new macro paradigm, we haven't talked about demographics, which is another big factor. I'm really where Mohammed is, in that these periods prompt innovation that's very hard to see from a sort of short-term perspective. On the investment side, actually, of course, we acknowledge very much particularly the market turmoil we had sort of earlier this year. But we're also seeing, continuing to see some really substantial opportunities, not least from the green transition. So it's a point where other investors are potentially pulling back, and of course the politics around climate change have become, let's say, more interesting in the last 6 months. We think the green transition is the most exciting and the biggest commercial opportunity for us, and we are the second largest infrastructure fund globally. And it's probably also why we're less down on Europe. So when we look at the energy transition in Germany, we look at greater stability in countries like the UK. For a long-term, patient capital investor, there are opportunities that we're seeing today that we weren't seeing 8 months ago.
I think you'll have to be very patient.
We're quite patient. As pensioners, we're quite patient.
Yes, Sunny, please come in.
Yeah, so I just wanted to pick up on one theme that Mohammed addressed, and I think it's really interesting in the question you asked him, because if you look at the development over the last 2-3 years, and this actually dates back to even like 2016 when we had Brexit the UK coming out of the EU. I think multilateralism has been weakened, and it's been replaced by a really complex patchwork of bilateral relationships. And so for companies, what that has meant is, in terms of the companies we're advising, they've had to switch from a mindset which is much more macro and global into understanding what is happening at the bilateral level. So what are the terms of trade and investment as between the UK and the UAE, South Africa, US, Canada, Australia? And the devil is in the detail, so you have to look into it. But I also agree with Dame Sharon. It isn't all doom and gloom, because as new trade relationships develop, then new opportunities emerge, but you have to do your homework, you have to invest, and you have to look into it. And I'm smiling because as a trade and tariff lawyer, I feel my time has finally come. I smile also because my dad still says, "Beta tu doctor kyun nahi baniya," which is something that, as all Indian fathers, they would typically still say anyway.
You can become the chairman of the world's largest law firm. And
Changes nothing.
It changes nothing, yeah. Your parents can still be like, should have become a doctor instead. Great. Federico.
No, I think beyond what has been said, the only thing I would say is linking to globalization, also the lower growth. I think, however, in tourism and travel, the growth perspectives are still ahead of the average trends. Even if you look to India, the tourism and hotel business is growing ahead. And that links not only to the global economy evolution, but actually how the lower classes are going up across all the countries. And as all available income comes, one of the first things people want to do is, to travel and build hotels. When you look, for example, to a country like India, there are 200,000 rooms, hotel rooms. This is less rooms than one big town in Europe.
That's right.
So when you think about, even if there is slower growth, there are some sectors that, given the economic trends, I think they will still give an opportunity. And they are less affected by more globalization or less globalization. It's very local. And I think, going back to your point before, globalization has been always important, but when I look to the hotel business in particular, still hotels, to be relevant, need to be local. Okay, you don't want to go in Delhi to a hotel that looks the same than a hotel, anywhere else in the world. And I think that localization in this industry is important. I think it will still play a very important role.
Well, we're going to live longer, so we have to find things to do. But it's not about...
If you're all so lucky as you.
It's not about doom loop. I think it's about realism. And the other feature that we see, and this punctuates the political area, is there's a change in the balance of economic power in the world. The dominance of the West, the dominance of the G7 is being eclipsed by the E7. And just point out that the GDP of the E7 is bigger than the GDP of the G7. And if you exclude China from the E7, and the US from the G7, the E6 is bigger than the G6. This is something that America, and indeed I think Western Europe, maybe to a lesser extent, finds very difficult to accept. I remember the American ambassador in Beijing said to a group of us, mainly Americans, last year, a small group, when we were traveling in Beijing before the American presidential election, that the relationship between America and China is structurally competitive. And as we all know America, most of the people in this room well, we know that the Americans like to win. And it's very difficult for America to accept a G2 or a multipolar world. And when one sees what India is doing politically, what the Prime Minister is doing, what Lula is doing in Brazil, maybe more emotionally, it reflects the change in balance between the Western economies, between what we might call the global north, misnamed, but call the global north, and the BRICS and the next 11 and the global south. And we're sitting here in India, and India is the epitome of what I'm talking about, certainly in the context of Asia. So I think it's realism. I think growth will be checked. It will not be as golden as it's been before. It doesn't mean it's not full of opportunity around technology and capital deployment, but it means the balance is going to shift. And certainly when we work with our clients, we're very focused on that day. And just the numbers are telling. The world's 106 trillion. US is 28 trillion. China is 18. Europe is 18. And when China gets checked, as it is being checked by tariffs, what do the Chinese do? They pursue what I call the Huawei strategy. Huawei gets checked in the US or the UK, and they go for the rest of the world. They put the 28 in America to one side, put the 18 in China, that's 46. There's 60 trillion of GDP that the Chinese can go for in that particular case. And remember, Madame Lagarde this week said, what did she say? She said that Europe has to look, because of tariffs, more closely at the opportunities with China. So a big battleground between China, for China will be EU, in addition to Africa and Latin America, which over the last 20 to 25 years, we've seen China build major trading partnerships with most countries in those regions.
Amazing. So I think this is a panel discussion where we have to be super cognizant of time, and I have 4 minutes left, and therefore I'm going to very judiciously deploy these 4 minutes. We speak a lot about AI. I would love to hear from any of you who has an example to give. What I want to hear is, what is the most impressive AI use case you have come across?
I go first. For me, the most impressive use case I've seen, drug discovery. Because that's a use case by which we can accelerate the development of drugs, and we actually can help save lives or improve lives by the billions, not by the millions. So for me, that's how you use AI. Not only it will speed up drug discovery, but also people's lives will be bettered, but also it's going to create additional value for the companies in the pharmaceutical business.
Is the world of law being... sorry, Sharon.
No, I mean, closer to home, deep research, upending professional services, and I bow to my legal counsel. This is you're talking about 25% cost savings in months, not years.
25% cost savings. Amazing. Sunny, is the world of law firms being disrupted by AI?
Listen, we are very mindful of the fact that AI will transform our industry. And I think the law firms that will succeed are the ones who are attuned to that, aware of it, and are trying to understand what is happening. I don't think anyone has got the answer yet, but be open to it and be prepared to be agile and be an early responder. So it's something we're following. I think in terms of your question, the most impressive uses of AI, I fully agree with Mohammed in terms of what we're seeing play out in drug development. It is breathtaking, it is spectacular, but come back and ask us that question again in a year. We'll have something new to add, no doubt, if we're invited.
Yes, Federico.
I will be very quick. I think in the hotel industry and the tourism industry, there is plenty. I mean, from the design of a hotel that it will be shortened by a significant amount of time and the speed to the back office work, to the personalization. However, I think for me, the most relevant one that is not only applicable to hotels is when a consumer tells you, I'm doing this because ChatGPT told me. And that's huge. Because during the last years, as I said, the source of truth has been spread around the world for influencers, social media, and suddenly I have seen consumers saying, I'm doing this because ChatGPT told me. That's what it says. So that source of truth is huge change.
So Martin, in 1 minute, your closing thoughts.
Okay, so I wanted to show you some films which showed you the collapse in time and cost for producing films and personalization at scale. But the most impactful impact of AI, in my view, and in the view of our firm, is democratization of knowledge. And just to be one example, Jensen Huang, the CEO of NVIDIA, has 51 direct reports. How does he manage to do that? If you went to PwC and said, what's the management span? You'd say 12 or 13 people. Certainly McKinsey would say that. And so 52 people, how does he do it? He does it through spreading knowledge horizontally through the company. So what you're going to see with AI, in my view, is a flattening of organizations. And Jensen doesn't do one-to-one meetings or many one-to-one meetings. He sets 5 KPIs or up to 5 KPIs for his direct reports and monitors their progress. This is a huge change. If I was going to write a book about advertising and clients and agencies, the biggest problem that we have is the silos that build inside organizations. And the reason that silos build is because people control information. Information is power. With AI, it gets disseminated horizontally across the organization. That is going to unleash, that is going to be the biggest productive power that we will see.
My colleagues are yelling in my ears now that the time is up. Thank you all so much. Such a distinguished panel. Ladies and gentlemen, a big round of applause for our panelists. Thank you.
Thank you, panelists. Thank you, SK. Okay, you have to remain seated. A couple of serious announcements you need to pay attention to. This is your last chance to get headsets if you need simultaneous translation from Hindi to English. If you don't have your headsets, go to the back of the hall and pick up those headsets right away. In a short while from now, the security protocol for the arrival of the Honorable Prime Minister of India, Shri Narendra Modi, will begin. This is what is called a silent period, and here are the rules of the silent period, which we'd request all of you to observe. During the next 20-30 minutes, you have to remain seated. The doors will be closed, and movement within the hall or outside will not be permitted for security reasons. We also request you not to stand up and not to attempt to exit the hall for the next 20-30 minutes. Also, refrain from photography, especially flash photography and videography. And for the last time, I'm going to repeat because I've been asked to repeat it, please remain seated. The Prime Minister will be here shortly. He will address this hall, and when he finishes, he will leave the hall. When he finishes his speech and leaves the hall, you still have to remain seated till he exits the hall for security reasons. I'm sorry for sounding a bit stern, but that's my unpleasant job to tell you the rules. Thank you for your cooperation, and the silent period begins now. So please remain seated.